Okay, folks, welcome to Retirement Fund Secrets and PGI Self-Directed. This is John Park, and today we're going to be talking about the differences between a Roth 401k self-directed plan and a regular self-directed 401k plan. What are the differences between these bad boys? Because on the surface, some people think, well, the only difference is the taxable base on whether or not the contributions are being taxed or not, but it gets a little bit more detailed than that. But we're going to take a few minutes here and explain why both are great, but the differences between the two. First of all, let's talk about some 401k, just basics. This is 401k 101. First of all, you must have a business to sponsor. So like when I'm visiting with a client, because I established both self-directed IRA accounts and 401k accounts, if somebody who is strictly a W-2 employee says to me, I want to set up a self-directed 401k, well, they can't do that. You either have to be self-employed or you have to be a W-2 employee that also has in effect a side job, some self-employment from another activity outside of the regular W-2 position. Assets grow in a tax-free environment. Remember with the 401k, you're not taxed on anything that you contribute until contributions come out in retirement. And then you're taxed on, since these were pre-tax contributions, you're taxed as the distributions come out and based on your tax status. Each year on a 401k, for even all the big boys, a $5,500 return must be filed. The exception to this is if assets in the plan are $250,000 and less, and the only participants are the owners and or their spouse. So this is a huge thing, folks, because a lot of people, when I'm talking about the world of self-direction, the first thing they think is, oh, it's going to be so complicated. Oh, I got to have all this paperwork done, blah, 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 blah. That is only true if, obviously, with a company has to file $5,500 each year. But in the case of a self-directed 401k plan, if it is a husband and wife team, for example, and they are the only participants, there is no filing. The only filing is if you have employees. Let's talk about Roth 401k Basics 101. First of all qualified distributions come out tax-free. Tax-free. Because remember, you're paying the taxes on the contributions going in. So I'm going to use an example here in a second, but if you put in $5 to your plan and that $5 grew to $100, great. You paid the tax on the $5. You will no longer pay any taxes on the growth of the plan. Here's where some people get confused. With the Roth, the assets have to be in the account for a minimum of 5 years, and, not or, but and, either death occurs, disability occurs, or the person reaches IRS age requirements of 59.5 for distributions. So remember, 5 years and death, disability, and or 59.5. Contributions to the plan, again, you're paying the taxes on it, so it's not deductible on your taxes. Matching is allowed, but it doesn't go through a Roth account. We'll talk about that more later. The differences between the Roth IRA and the Roth 401k. Well, while the Roth IRA and the Roth 401k share the same name and basically have the same features, they are definitely different tools for different people. The first difference is income limitations. Roth IRA, a couple married filing jointly cannot make more than $166,000 a year in order to qualify for that IRA contribution. If they make less than that, they qualify for the full contribution. If they make between $166,000, and I believe that's on a sliding scale, and I believe to $176,000, they can contribute somewhere between the limitations are $5,000 for 2009 for someone under the age of 50, $6,000 for 2009 over the age of 50. So between that $166,000 and the $176,000, there's a sliding scale on it. If the person was under 50, it wouldn't be $5,000. It'd be on a sliding scale between those $2 limitations. Over $176,000, no contributions of any kind. With the Roth 401k, there is no limits on earnings. Now with a 401k plan, here's the other nice thing. With a 401k plan, you can also contribute more. $16,500 under the age of 50, $22,000 over the age of 50. Also, if you're incorporated, your company can match that, and you can also participate in profit sharing. And with profit sharing, you can go up to $49,000 or 25% of your compensation, whichever is less. Are you starting to see why a Roth 401k is much better than a Roth IRA? But wait, we're not done. That's just on the income limitations. Are there income limitations on the Roth IRA? Yeah. About debt finance income. With a Roth IRA, yes, you have debt finance income. With the Roth 401k, you do not. Let's use a practical example. John's Roth IRA borrows $90,000 to buy a $100,000 property. John's Roth makes a profit of $200,000 on the property. John is subject to profit on taxes for the debt finance income rules. In this case, $180,000 would be subject to those taxes. With the Roth 401k, same example. John's Roth 401k, as compared to the IRA, borrows $90,000 to buy a $100,000 property. John's Roth 401k makes a profit, the same, of $200,000 on that property. None of the profits are taxed as long as the transaction was established correctly and compliant with IRS regulations. Let's talk about another huge difference, loans. If I borrow money from my Roth IRA, it is fully distributed. In the eyes of the IRS, it has now blown up. I can't take the loans. So if I took out a loan, the IRS is going to subject me to full taxation on my account and is going to also receive the 10% penalty. If I borrow money from my 401k, I just have to pay it back. It is not considered a taxable distribution. How great is that? This is the third huge feature as to why somebody should consider a Roth 401k versus a Roth IRA. So again, summarizing, can a Roth IRA take out loans? No. Can a Roth 401k? Yes. Prohibited transactions, one of my favorite things to talk about. The IRS says that if you do things that are not permitted with your plan, and this is for any IRA or for any 401k, even with the big boys, any joint investments that people make, there's going to be a high likelihood of a prohibited transaction. So this also is going to be something of significant force that is going to basically separate a Roth IRA and a Roth 401k. If that prohibited transaction occurs with the IRA, it will be considered, your plan will be considered fully distributed like we talked about, plus the 10% penalty. Assets can be pooled much easier with the Roth 401k. Also, a prohibited transaction in the 401k will only create a tax penalty for the amount involved, not for the entire amount. So if you had a prohibited transaction with your IRA and you had a $200,000 balance in your Roth IRA, it is now considered fully distributed. All $200,000 would be subject to tax and penalty. With the Roth 401k, if you were making a $5 investment, only the $5 would have a penalty tax associated with it. So again, summarizing, prohibited transactions, yes for the Roth IRA, no for the Roth 401k. Easy reporting, yes for the Roth IRA, no for the Roth 401k. Rollovers into a Roth IRA, yes. Here's one benefit, so to speak, to the Roth IRA as compared to the Roth 401k, but probably the only one. Can you take a Roth IRA and roll it over into a Roth 401k? No. I hope the IRS changes rules pertaining to this down the road. But right now, that is not permitted, so that is one, I guess, non-benefit to the Roth 401k.